In 2008, it started with mortgages. Nobody thought those would blow up the entire global economy. But they did. Last Friday, BlackRock, the largest asset manager on the planet, controlling $11 trillion in assets, told its investors something extraordinary. You can't have your money back. Not all of it, not yet, and here's the thing, it's not just BlackRock. Three of the biggest names in private finance, same week, all limiting withdrawals. Here's the question nobody on Wall Street wants to answer out loud, is this how it starts again? Before we get into what happened, you need the backstory. None of this makes sense without it. Over the last decade, a new kind of lending called private credit quietly exploded onto the financial scene, and most Americans have never heard of it. Here's the simple version. After 2008, regulators cracked down on banks with new rules and stricter limits. This meant banks pulled back from certain kinds of loans, especially large, risky ones to companies already in debt. Into that gap walked private equity firms, hedge funds, and asset managers. They said, we'll make those loans. No regulators watching, no problem. Fast forward to today, and that market, private credit, is worth nearly $2 trillion. $2 trillion in loans from firms that aren't regulated like banks and, here's the part that should concern you, aren't required to tell the public much about what's inside them. Does that sound familiar? It should, because the last time we had a massive, fast-growing, lightly regulated corner of finance that nobody understood, it nearly took everything down with it. Here's a number. I want you to actually sit with this one. Private equity-backed companies make up roughly 7% of the United States economy, just 7%. But in 2025, those same companies accounted for 54% of the largest corporate bankruptcies in America, the billion-dollar ones, the ones that make headlines. 54% of the biggest failures, from 7% of the economy. And in retail, it was even more extreme. 71% of the largest retail bankruptcies last year were owned by private equity firms. Joann Fabrics, At Home, Claire's, gone. That is not bad luck. That is a pattern, and it's getting worse. So why? Why are private equity-backed companies failing at twice the rate of everyone else? The answer comes down to one word. Debt. Private equity's entire business model is built on borrowed money. They find a company, buy it using mostly debt, not their own cash, load that debt onto the company itself, cut costs, try to grow revenue, and then sell it a few years later for a profit. When it works, the returns are enormous. But here's the flaw in the model, and it's a big one. Then the Federal Reserve started hiking rates, and they hiked fast. Suddenly those cheap loans became very expensive loans. Companies that were barely keeping up with their interest payments found themselves completely underwater. And when you can't pay your interest, you default. When you default, someone has to absorb that loss. But here's the part most people are missing entirely, and this is critical. Who exactly is eating those losses? Because it's not always obvious, and in the world of private credit, that opacity is very much by design. The industry will tell you private credit default rates are low, under 2%, nothing to worry about, move along. But here's what they're not telling you. When you account for something called payment in kind, where a struggling company literally pays its interest bill with more debt instead of actual cash, and you include so-called selective defaults and liability management exercises, the real default rate is closer to 5%. That is more than double the headline number. And payment in kind. It's risen to account for about 8% of income in these funds. Think about what that actually means. Nearly $1 in $10 that these funds are claiming to earn isn't cash, it's an IOU, from a company that's already struggling to pay its existing bills. They are hiding stress inside the numbers. The question is, how long can that last before it becomes impossible to hide? Which brings us to last Friday, March 2026. BlackRock manages a private credit fund worth $26 billion. It's one of the largest in the world, and it offers something relatively unusual for this type of fund. Periodic liquidity, meaning investors can ask for their money back on a schedule. Well, investors asked. A lot of them. They requested 9.3% of the fund's total value back. That's over $1 billion in withdrawal requests. BlackRock said, "We'll give you half." They triggered what's called a withdrawal gate, a built-in mechanism that caps how much investors can take out at once. Now, the industry will tell you this is fine. Gates are a feature, not a bug. They exist precisely to prevent a panic-driven stampede. But here's what makes this different. Same week, Blue Owl allowed investors in one of its tech-focused funds to cash out roughly 15% of net assets. Three of the biggest names in private credit. That is not a coincidence. That is a signal. Now, here is where this story stops being about wealthy investors losing money in fancy funds and starts being about the rest of us. Banks. Major United States banks have lent approximately $1.14 trillion to private credit funds and private equity firms, and many of those loans come with mark-to-market provisions, meaning, if the value of the fund's loan portfolio drops, the fund must post more collateral to the bank immediately. So here's what a crisis scenario looks like. That is a doom loop. And it is the same basic mechanical sequence that brought the financial system to its knees in 2008. Let's be honest and balanced here, because this shouldn't be about fear for fear's sake. Is this actually 2008? There are real differences. Banks today are far better capitalized than they were. Post-crisis regulations forced them to hold much larger buffers. They run stress tests. They're not as exposed as they were when Lehman went down. Private credit loans, while risky, are also simpler instruments than the layered opaque mortgage-backed securities that caused the 2008 collapse. But here's what should keep you from getting too comfortable. The Federal Reserve Bank of St. Louis made this point clearly. It's the interconnectedness that creates systemic risk. It doesn't need to be the same instrument as last time. It just needs to be connected enough to the banking system to spread. And Harvard researchers studying this exact system concluded that while the scale is still manageable today, the direction of travel points toward growing systemic importance. Not a crisis today, but a system that is getting more dangerous every single month it continues to grow. Here is the part that nobody is talking about loudly enough. Regular people suffered through the recession, job losses, housing collapse, but the first wave of financial losses landed on Wall Street. That has changed. Institutional ownership of these vehicles has dropped from roughly 40% before the financial crisis to about 25% today. The typical investor in these funds isn't a sovereign wealth fund. It isn't a pension manager with a team of risk analysts. It's you. If this unravels, and I'm not saying it will, the losses don't just stay on Wall Street this time. So what do you actually do with this information? Here are 5 specific warning signs. Watch for these. Number 1. Refinancing cliffs. 2026 is a heavy year for private equity debt coming due. If companies can't refinance at affordable rates, defaults spike fast. Watch the news in Q2 and Q3. Number 2. More withdrawal gates. If 3 firms becomes 5 becomes 10, that is no longer isolated stress. That is a trend. Number 3. Bank earnings reports. Listen for increased provisions for credit losses tied to leveraged loans. That's how banks quietly signal they're getting nervous. Number 4. Federal Reserve language. If Fed officials start specifically naming private credit as a systemic concern in public statements, they are seeing data the public isn't. Number 5. Payment in kind ratios. If PIK percentages climb past 10% across the industry, more and more borrowers are paying interest with IOUs. That is a clock ticking towards something. 2008 didn't start with a crash. It started with a crack. A few mortgage defaults here, a couple of obscure funds freezing withdrawals there, things that seemed contained, isolated, fine. Until they weren't. I'm not telling you the crash is coming, but I am telling you, the people asking the hardest questions right now are the same people who saw 2008 before it happened. Watch this space. If this video helped you understand something the news isn't explaining, share it with someone who needs to hear it, and subscribe, because if this story develops, you'll want to be ahead of it.